Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
At this point, I want to turn it back to Jack, and Jack will describe all the different services that he has, and then we'll answer all your questions.
Sure. We basically have two newsletters at Black Swan. We have a currency you can get free. It's our daily global macro view every day. Come to our site, and then we'll send that out to you for free, right to your email box. And we have a currency strategist, which is our subscription-based service, and we offer recommendations on trading the FX options product on the ISE, spot currencies, ETFs, a lot of different currency classes and different time frames. And we produce that letter every day. Thanks, Steve.
Thanks, Jack. Okay, let's get to the questions. Lily has a question. Jack, can you explain a bit about the relations between the U.S. dollar and bond interest rate, oil, and commodities? I think you went through it, but is there a simple answer that, how you look at the markets?
There's no simple answer other than in the environment we've been in of late, it's been fairly clear-cut. Rising commodity prices, rising oil prices, rising stock markets have tended to be bad for the U.S. dollar just because of the nature of the fact that most of the opportunities have been offshore, as I said. Bonds have been you've seen bonds kind of do their own things at times, so it's not as clear-cut there. From a bond perspective or interest rate perspective, it's, as I said, it's a little trickier and has to be taken really, in and of itself. Obviously, when you see spikes in bonds, in particular U.S. Treasury bonds and other bonds around the world, we saw this. When you see major spikes in government bonds, you can say to yourself, there's some fear in the world going on out there. People are afraid of what's going on, so they hide their capital in bonds or short-term bonds in particular. And when that happens, in general, when people are afraid and run the bonds, they're going to the world reserve currency, the U.S. dollar, is going to tend to do well. So those are the ways. Excuse me. Those are the delineations that we've been seeing really since 2001. That has continued so far. Just making the point. These correlations may change because of the fact we're no longer, at some point I think they may change because we're no longer in that major liquidity money racing all around the globe as it did before for yield. What I mean by that is all the central banks in the world are tending to lower their interest rates, so we're seeing a normalization of interest rates. So at some point, we believe, and we're obviously not there yet, the currency question may be more based on fundamental evaluation of the country as opposed to these hot money flows in these higher interest rate currencies and back out based on these ebbs and flows of all these asset classes. If we get a more normalized, slow growth environment, I think we're going to start falling back more on individual country valuations.
Interesting. Jack, here's another interesting one. I think this is going to sort of be a nice segue to your presentation on June 4th. At least I'm guessing this. Jack's going to be back at the ISE on June 4th talking about why the euro could disappear. And Dennis wants to know, Jack, if you believe that we're going to get a common currency around the world at some point, or maybe one or two, what's your view on that, the potential of maybe one here in North America and then maybe even merging it, with some other currencies later on in the next decade or so?
Yeah, not too long ago, I used to think that view was extremely far-fetched. But the more I watch the U.S. government totally abuse the world reserve currency status of the dollar, which has given them a lot of status and a lot of power, the more I watch what they're doing in terms of trashing our bond markets and everything else, the more that probability is rising. Ultimately, you need a stable currency foundation to have stable globalization and trade and capital flow. And in this environment, every government seems to be doing whatever they can to trash their paper currency, which were weak before we went into this cycle. So I don't see this as a near-term event because I don't think the major powers have the ability to set up these relationships very, very quickly. But I can see the probability of new currencies or more global type currencies arising over time. But right now, given all the dislocations, I think that's one of the last things we want to try and implement. China's making a lot of noise about it. Russia is too. I think they're using that for a lot of political points to try and get the U.S. to do things they want to do. So I don't take that for face value. But sadly, the probability of a change in the world reserve currency status in the U.S. Is starting to morph. And one thing I think you can watch is oil. If more and more countries start to price oil in another currency, we're starting to see Brazil and China link up, and Brazil is going to start pricing some of their commodities in the Chinese currency. If we start to see more in that in a global basis, then the probabilities of some type of change or global currency, I think, rises dramatically.
Wow, Jack, that's, you know what, it's funny that you touched on that last part because Fred just wanted to know that exact thing with China, Brazil, and Argentina dealing with their own currency. What's the effect? So you thinking that if we don't do something soon to stop trashing our currency, you know, I guess it's going to lead to other bad effects? Yeah,
and I think it will. And you can understand the the globe. I mean, if you had to rely on the U.S. as being the driver of responsible finance, and you see them doing what they're doing, it has to concern you, and you have to be looking at other avenues to protect yourself, and I think that's what these countries are doing.
Interesting. Bill has a question. Do you see the Aussie as a proxy for risk appetite instead of the yen? It's interesting. What do you think there?
The reason we look at the Aussie is, to us, it's been more clear-cut. Obviously, the yen at key moments has been a big, has really ticked off some yellow flags or some red flags, so to speak. The major move in the yen during the Asian financial crisis, we saw a lot of the hedge funds pile in and borrow yen in late 1990s, mid-1990s. And it created the Asian financial crisis, and the yen took off like a rocket. And we saw that obviously again at the end of this credit crunch. All the hedge funds were borrowing Japanese yen at 0.5% or 0.25%, leveraging it up and buying risky assets. And when deleveraging hit, the yen rocketed. But in general, the yen is not as clear-cut. It sometimes moves in its own orbit. And let me just give you a current example. Right now, we've seen a major risk appetite move in stocks, as I've just talked about, but the yen is also appreciated during this time, where in the past, when we've seen these major risk appetite moves, the yen has depreciated in value against some of the major currencies and the U.S. dollar. So the yen often moves in its own orbit and less at those key points. So that's why we think that the Aussie is a much clearer cut picture.
Interesting. That's very interesting about the correlations, Jack. Thanks for that point.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.